Welcome to the Edified Equity Podcast. My name is Dino Pierce, CEO of Edified Equity, and I'm coming to you today from beautiful Lakewood, Colorado at Bear Creek Reservoir. You can learn more about us on YouTube, iTunes, Stitcher, Facebook, and our award-winning blog on Bigger Pockets. Today I want to take a minute and talk to you about something that has been sort of a hot topic in today's market, and it's something that I've been having deep conversations regarding with other operators. So I wanted to share a little bit of insight with you regarding cap rates. The majority of operators will actually close an offering memorandum, not even take a look at it, just from hearing it's, for example, a 5 cap or a 6 cap, when the market is calling for a 7 cap, let's say. And what I want to discuss is why that could be a big mistake. And instead of just shutting the door before analyzing something, you should really think twice and take a deeper dive. So let's do a case study. Today, what we're going to do is pretend that we've already chosen the proper market. It's in the path of progress, it's growing, the economy's booming, and we expect it to be in this path of progress for quite some time and ride out the market cycle. And what we've identified is a 172 unit apartment community. Great market, but we're in a 7 cap market. Now our building is a 6.34 cap. Right there, some people would say they want too much, I'm not interested, and shut the door on this opportunity. But let's dig deeper. We have a purchase price of $5.5 million. Market is 7 cap, like we discussed earlier. But not only do we have a lower market, we're also getting the opportunity to get a lower price per door. And that's going to determine the difference between this actually being a deal or possibly not a deal. So in the situation that we're describing now, our price per door is closer to $32,000 a door versus what the market is demanding at $40,000 to $45,000. And that is a big difference. So let's dig further. When we continue analyzing, we verify with our property manager, we verify with brokers and a few other reports local to the market, we actually realize that we're about $150 below market. So what we do is we're going to come up with a 12-month plan. And in the first 12 months of owning the building, we're going to bump rents. Not by 150, which is where market is. We're going to bump to 100, leaving us still very conservative and one of the best options on the block, remaining $50 below market. We're also going to improve our operations. This is actually not a value add play. This is an operational upside play. We're simply taking an asset that has been left with decreased rents for far too long, simply because the current operators, which were mom and pop owners, were simply afraid to take a hit on vacancy versus increasing rent over time with the market. But we're not going to do that. We're professional operators, and we're still going to leave some room, and I would like to be something that's very economical and have a high occupancy rate, but I don't want to do it at the cost of keeping the NOI too low and affecting the returns and the value of the building. So with our operational upside, we're also going to decrease our expenses by 10%. Now, talking with property management, we actually believe we can decrease by 15%. So again, we're staying on the conservative side. And we're going to use a cap rate, even though we're in a 7 cap market, we're going to use a cap rate of 8% to see what the new value of our building is going to be after we implement this upside approach. So through our operational upside approach, we are actually, by bumping the rents $100 as leases expire and upon natural turnover, and by managing our expenses more efficiently, we're going to increase the net operating income of the building by $173,392 a year. If we use the 8 cap to get a new value of the improved NOI, our new building that's throwing off more cash, the value is now remember, we purchased it at a 5.5 cap. The value is now $6,527,400. That's an increase of $1,027,400. Now, we didn't have to put a ton of money into the project. We simply operated it better. Most buildings are going through some type of operational distress, and there's a lot of value that can be added through managing it properly, choosing the best-in-class management company that's local to the market, and knowing how to effectively manage the manager. So in this scenario, for every dollar that we increased our NOI by, the value of the building actually increased by $5.93, almost $6. For every dollar we made more on the NOI, the building appreciated by almost $6 additional. Now don't get me wrong, cap rates have their place in analyzing deals. I do think that at first glance, looking at a cap rate, a lower cap rate in a market that is calling for a higher cap and simply throwing it out the window is a huge mistake. And we should all take more time in delving into the numbers, seeing if the price per door is also low. So don't get me wrong, I'm not advocating for buying a low cap rate with a high price per door. That rarely ever makes sense. You'd have to be playing on the coast, and those are more liquid type assets, which it's definitely not our niche, and it's nothing that we go after. We're looking for more of a longer play, and we want to add value as well as improve operations. But nonetheless, I think looking at the cap rating, throwing a deal to the curb is a mistake that a lot of operators are doing, and we should dig deeper and reevaluate the cap rate. I hope you found this information helpful. Please share. This is Dino Pierce, CEO of Edified Equity, signing off. Make it a great day. You certainly deserve it. Goodbye.